Well, greetings once again, Bentley alumni, family, and friends. Thank you for joining us today for our virtual event. I'm Emily Williams, Director in the Office of Alumni and Family Engagement. Before we get started, I do have some light housekeeping. After this session, we'll be sending out an email with a recording and a survey to gather your feedback on today's session. Every Sunday evening at 6 p.m. Eastern, we do send out an email digest with our upcoming virtual events. So keep an eye on your inboxes for both of those emails. Thank you to those of you who submitted questions in advance. We had quite a few, so thank you again. Our speakers will address several of the pre-submitted questions on this webinar. If you have a question arise as you're listening, please feel free to put it into the Q&A box that's located at the bottom of your screen, and it will be considered for response during the question and answer session. Lastly, if you need technical assistance, please use the chat box to speak with us directly. My colleague Bethany will be responding to your questions as best she can. And today's featured speakers are Aaron Jackson, Eylem Senyuz, and Marianne Lancaster. Aaron grew up in Eugene, Oregon, earning his bachelor's and master's degrees, as well as a PhD in economics from the University of Oregon. He's usually seen wearing green proudly. He's been with Bentley for almost 20 years, serving as the director of the honors program for 6 years, chair of the economics department for 2, and since January of 2020 as the associate dean for undergraduate business programs. His general interests in both teaching and research revolve around macroeconomics, with a special emphasis on the role of monetary policy. His current research explores the institutional structure of the Federal Reserve, communication strategy, and credibility. Marianne, class of '88, used personal savings and a loan from a longtime mentor to launch Lancaster Packaging out of her home in 1989. Today, the wholesale packaging distribution and procurement services company operates a 14,000 square foot facility in Hudson, Mass, serving industrial manufacturers and U.S. aerospace and defense companies. It has ranked among the Boston Globe's top 100 female-led businesses for 10 years. As SunTrust Advisory Services, Inc.'s Director, Global Macro Strategist, and Senior Vice President, Eylem Senyuz, MBA class of 2000, is responsible for analyzing global economies and financial markets, as well as helping formulate and communicate investment strategy. As a member of the Portfolio and Market Strategy Group, he helps to develop asset allocation strategies that drive the management of approximately $50 billion of private and institutional client relationships. Prior to his current role, he was a member of the Global Fixed Income Investment Management team at T. Rowe Price. Senyuz earned his Master of Finance degree at Bentley, as I mentioned, and is an adjunct faculty member at Georgetown University. Without further ado, I will thank you all for joining us and turn the conversation over to Aaron. Thank you all.
Thanks, everyone, and thanks for everyone joining online to witness. But I think it's going to be a fascinating conversation. I just want to take advantage of the time and give a special shout out to a few of my former students who I did see pop into the audience. Sean McEwen, Guillermo Fernandez, Tim Kelly, and Dan Batista. So welcome. Good to see you guys here, as well as everybody else who's in participation and in attendance here. So let me start off. I'm going to put my professor hat on, and so for those of you who are former students, this might look a little bit familiar, but I want to go through just a brief sort of overview of inflation and sort of how to think about it in context where we're at right now. So if you look at inflation, typically the way that a lot of people think about inflation is through the lens of what's referred to as the CPI inflation index. That's the most common one that most people think about. You can see that measure has gone up to almost 5% quite recently, so it spiked pretty dramatically. There's a number of shortfalls to that that you might remember from your Econ 101 classes. Primarily, the idea is that that's sort of a predefined fixed basket of goods, and so it doesn't necessarily represent the true impact of inflation on individuals and their consumption behavior, because it doesn't represent what people actually buy. It sort of presumes what people buy. And so because of that, the Fed actually focuses more on an alternative measure, which is called the PCE inflation rate. So this is a similar measure in that it captures the inflation that's focused primarily on consumption goods itself. But the difference is that it actually reflects the actual purchases of people in terms of their consumption patterns. So it's more reflective of the actual impact in a lot of ways of inflation on households. But there's a lot of volatility in that because of transitory effects through things like food and energy prices, which tend to go both up and down fairly frequently in short horizons. And so to understand a longer term trend of how inflation is behaving, the Fed tends to focus more specifically on that core PCE inflation rate. And so that, as you might remember, strips out a lot of the strips out the food and energy components of inflation. Okay. So focusing on the PCE inflation measures, how is it that we've gotten to this high rate of inflation today? Well, if we look back about a decade or so, the Fed has had for quite a while a 2% inflation target. Okay, and that's again specific to the PCE inflation rate. Now, over the last 10 years, so from 2010 to the end of 2020, the core PCE inflation rate, so that's the thing that strips out food and energy, has averaged 1.6%. And so that's well below that 2% goal that has tried to achieve. And in particular, if you look at that gray line represents the core PCE inflation rate. It's hardly ever gone over that 2%, and most of the time it's under. And that green line is the average of that core PCE inflation rate. So that's presented some problems for the Fed in that it's been hard to reach that 2% target precisely because inflation has been so low for so long, and that tends to have a reinforcing effect on price and wage setting expectations for inflation. So because inflation is low, people expect low inflation, and that results in low inflation as well. And so because of this low inflation environment for a while, the Fed switched its strategy a little bit in the last year or so to what's referred to as an average inflation targeting framework. And so the basic idea is that if inflation is below 2% for some period of time, then the Fed is going to be a little bit more aggressive in accommodative monetary policy in order to achieve higher inflation in the near term, so that on average, inflation is going to be about 2% per year. Okay. So with that sort of context, that sort of gives us a baseline for an already sort of overly accommodative policy, just to sort of catch up to that 2% average inflation that the Fed is trying to hit. Okay. And then we throw that thing called COVID in, right? And so you have massive amounts of fiscal and monetary policy that's occurred since early last year. As you recall, the economy ground to a halt in the spring of last year because things were on lockdown. So you had the Fed reduce the policy rate to zero. You had massive bond buying programs reenacted by the Federal Reserve, both of which put tremendous upside demand conditions on the economy. And then you, of course, have on the fiscal side trillions of dollars of fiscal support that have also poured into the economy. And in fact, during a period in which the economy was in lockdown in that spring of 2020 period, even though a massive amount of people were out of work and unemployed, measures of incomes in the economy were actually higher than trend averages prior to the COVID period. So that speaks to the forcefulness of the fiscal policy response that occurred. So all of that is putting upward pressure on demand, therefore creating some inflation pressures. The second factor is what's called these so-called base effects. And so again, in that period of the spring when the economy shut down, you had a large swath of sectors of the economy that shut down operations, demand fell, particularly in leisure and hospitality, travel, services, those kinds of things. And so you had this decline in demand, which results in a decline in prices, Econ 101, right? And so because of that, and because the way we measure inflation as a year over year, so you look 12 months back from where you are today, well, that gives you sort of an artificially low price level to be measuring inflation from. And so in that period this year, in the spring and sort of early summer period, we're sort of measuring that inflation effect from this artificially low baseline. And so naturally, inflation is going to start to be higher than what you might otherwise expect with those types of demand side conditions. And then the third is supply chain issues. And this has become pervasive everywhere. There's not a day that goes by over the last month that I haven't seen an article in the newspaper or online about supply chain issues. And it's across the board in every sector and globally. And both our guests are going to be able to speak to that very soon. But in this picture here, I've captured that through the so-called producer price inflation index. So that's that yellow line that's measured on the right axis. So the producer price index is simply a measure of prices for inputs of goods and services that that firms use to produce other goods and services and sell. So you can see that thing has skyrocketed, and it's about 20% right now. And so the one thing to keep in mind with this picture that you see is that it actually moves on a trend level, not on a quantitative one-for-one basis, but on a trend basis. It moves pretty well with both core and headline PCE inflation. So in other words, when you see the soaring input costs through PPI, that's going to result in a translation or pass-through into broader prices that we see, that you can see in the data right there. And then lastly is this issue of tight labor markets. Some of you might have went into a restaurant recently, looked around, and the tables, there's like a third of the tables are full. You ask for a table and they say it's going to be a 30-minute or 45-minute wait. And you kind of scratch your head and say there's 3 tables. And well, the issue is that they don't have staff to actually service those tables and cooks in the back and things like that. So we've seen a lot of instances, again, anecdotally in the news recently about firms having a hard time finding workers, which Marianne is going to be able to speak to us about. And so that's created a lot of pressures on wages. This picture here, you can see the green line is the overall hourly wage growth rate. An interesting sort of slice of this is actually if you look at the yellow and red lines here. So that yellow line is the wage growth rate for folks that switch jobs. So they leave their job to go to another job. The red one is the wage rate for people who stay in their jobs. So you can see more recently, there's almost a 2% gap there, right? So it pays to leave your job and go find someplace else where wages are rising, trying to attract workers from a very, very tight labor market. Okay. Last picture, and this shows the an aggregate employment picture. So let me explain what you're looking at here. The blue line, which is on the left axis, is the labor force participation rate for so-called prime age workers. So that's the workers from 25 to 54 years old. So these are the folks that we should expect are able to work, they're willing to work, they're not retired, they're not going anywhere, right? The right axis, the orange line, represents the amount of employment of that prime age cohort. Okay, so this is the total number, and on the right axis, that's in thousands. So you can see the top end is at 103 million, and the bottom end is at 85 million. Okay. So you can see that something happened in early 2020. There was a recovery, but we're still quite a ways off from even the peak at the end of 2020 there. And in fact, that's about 3.3 million less jobs from that prime age cohort alone that aren't back in the labor market, right? So where do they go? Where are they? Well, there's a few explanations, and this is not exhaustive. Because of the effects of COVID, there's been a tremendous amount of dislocation in terms of the supply and demand for labor. There's been a lot of mismatch problems in terms of workers. There's been issues of childcare and the affordability and availability of childcare for people who go back to work. Related to that is a more general issue of, you know, if people don't have to, maybe they just don't want to go back to work, right? And then there's also issues of health concerns, people concerned about going back to the workplace, being around others because of the lingering effects of COVID. So there's a number of other things that you can sort of add to that list, but those are a few off the top of my head. And so all of these are, as I said, are sort of contributing to this this story of inflation. So a couple of questions that people submitted early on that I wanted to touch on briefly, and then I'm gonna turn it over to Marianne. One is the question of whether inflation is driven more by current supply chain challenges or monetary policy. The Fed has made it clear, or at least they've tried to explain the fact that a lot of the inflation that we see is relatively transitory. These supply chain things and the labor tightness is going to be around for a little while, I think, at least the next year or two. So we're likely to see elevated inflation as we continue to work through these supply chain issues, as labor continues to be tight, both in the US and globally. And oh, by the way, again, because of the Fed's average inflation targeting framework, they're not likely to, just start raising rates right away to make sure that inflation is exactly 2%, right? Again, the idea is that they're going to allow inflation to go over that 2% mark in the near term in order to, over time, allow inflation to get to an average of 2%. So with that, let me stop my screen here. And I want to kick it over to Marianne, and I want to invite her to talk a little bit about what her business is, what she does in her firm, and talk about a little bit about these issues that we speak about in terms of, pricing, cost pressures, labor shortages, and sort of what that means for your business. So take it away.
Good morning, everyone. So Lancaster Packaging is an organization that is in wholesale distribution for many categories, servicing manufacturing in different industries. We do quite a bit in aerospace and defense, and a lot of just manufacturing, which could be related to elevator manufacturing to someone making parts locally. We started in packaging materials and industrial supplies, but over the years moved more to a supply chain management organization where we're actually managing manufacturers and not just distribution. We distribute across the country. Our suppliers are in the US and outside of the US. And what we're seeing, basically what Aaron is talking about, is that severe stress in supply chain. The climate is horrific. We have manufacturers that have current customers on allocations. So if you can't get your raw materials or any goods to flow through, whether you have labor to have those lines being in production or not, you don't have the material. We are seeing severe transportation costs and severe delays in transportation. And I can give you an example of product that we've had sitting in a ship 2 miles out in LA for over 2 months from China, just sitting there, just not having the labor to unload containers is severely hurting, the US manufacturing base. Many organizations are just searching for suppliers and searching for, other sources, and manufacturers both inside the US and outside have basically said, if you aren't a current customer, we can't support you because we can't even support the needs of our current supply base. So we've seen such a tremendous demand and shortage. We talked about, the 20% average on customers and suppliers, but we've seen it go up to 60%. Anything based in resin-based, oil-based is 45 to 60% from a year ago. And we're getting another influx of increases in many categories. So when you talk about, will the customer pass along these increases? They really don't have a choice. You're really looking at, can I even get anything? And people are paying, manufacturers and corporations are paying whatever they can to get it outside. And you're basically an organization that we've become glorified expediters and, researchers looking for material alternatives. I do have to say that and this could be very temporary, like talking about the transitory difference in supply chain, is that we've seen that we're getting business, that companies that we're buying outside of the US are now saying, what do you have? And organizations are saying, maybe long-term, we need to mitigate our risk. Maybe we end up with new business that we have 100% now because they can't get it in China. Maybe we do end up long-term after 2 years of getting 20, 30% because organizations can't rely 100% for their supply chain outside of the US. And that kind of gives it, sums up what we're dealing with. On the labor side, Aaron, I do want to comment on everything that you said we're seeing, but I'm also seeing a strange, the last piece you talked about, like almost like a cultural shift about, do I even want to go back to work? We have some people that left to take care of children, and obviously the prices are crazy in daycare, but it's also saying my way of life is different. My quality of life is better. We have just an example, one employee that is taking care of their children, but they're back part-time to school, but they're doing Instacart. They're doing these unique things, but to them, the income is not there, but we're seeing this identity crisis, I should say, in the market. That's kind of throwing a lot out there, but our organization is feeling everything that you described.
Marianne, can you talk a little bit more about the hiring part? How many workers do you have? Are you looking for workers right now? How are you reaching out to try to find those workers?
So we are a small organization. We only have 14. We just actually landed a driver for local New England delivery, and it took about 2.5 months to fill that position. 25 interviews, folks just not showing up for interviews, and you say, oh, they're just taking the Indeed ticket and going to unemployment, but the unemployment benefits, you're not getting that extra any longer. So it's severely hard to find folks. We've actually increased our overall salaries for open positions by 20 to 25%. We've seen in wholesale distribution, not only the salaries go up, but anything they can offer, unique working service environment where it can be home, where it may not have been home, long-term, permanent, not just during COVID. We've had folks say, can I be permanently at home? Signing bonuses that are actually, unbelievably, for us as a small company, we can't afford that. We can't compete with the large organizations like a UPS that can give a signing bonus. So it's been very tough.
Yeah, and I think that goes to the question that Sean McEwen asks, which is, what does this mean for the leverage of employees in terms of getting more money or negotiating for more flexibility benefits? I think what you described speaks to that.
The leverage is there, and a lot of our customers who are large, we work with Mass General, we work with a lot of aerospace, British Aerospace, Sikorsky, Aircraft. All of these organizations are changing. They're offering permanent home positions. They're offering, more flexibility overall in all of their benefits.
And what has all this done to your cost pressures? What has this done for your pricing? How have you responded to this environment?
So for majority, we've had to just pass it along. You're in constant negotiations, and we are eating some of that. And then some of our contracts are fixed pricing over a long period of time. Say if it's a 12 months fixed price, what do you do then? So it's constantly a management of costs rising. On average, I think our costs are at 35% overall.
35% higher than last year?
Higher than before COVID, yeah. And it's still rising.
Wow.
So we're basically having to pass it along. And we've actually, I think the first 4 or 5 months of the year, many organizations, their first reaction was, we're going out to bid, right? So you're bidding everyone that may have bid in the past, and you're bidding all these contracts, which takes up time. And then you're basically, before the bid is even reviewed, you're going back and having to negotiate the price. Oh, we can't hold that pricing. We have several large corporations that are still haven't closed out their RFQ process for national bids because, it's going on 4 months, because you can't You can't lock in a price. So you're just doing consumer price index formulations on the pricing. And I have to say, in my world, in the packaging world and industrial supplies, in the past 30 years, it very rarely do raw material manufacturers go down. I'll give you, when the price drops 5%. So it doesn't always go up and down. It just keeps passing the increases along.
Yeah. Thank you, and I'll probably come back to you, but let me jump over to Eylem. And Eylem, why don't you just talk a little bit about what you do in your job and sort of how that fits in with this discussion.
Sure. I work for Truist Financial Corporation, which owns two banks, the SunTrust Bank and BB&T. We had the merger 2 years ago, and I have to have a disclaimer related to that as well. I'm participating to this panel as an alumni instead of an employee of Truist Financial. So whatever I say, they may not agree. Not only Truist Financial, but their affiliates as well. So these are my personal opinions. So what I do for a living is I cover the global markets. So anything outside of the US is kind of my territory. And before Truist Financial, I worked for a company called Ashmore Group, which is an investment manager that's investing into emerging market bonds, equities, and also private equity. Before that, the name of the firm was Emerging Market Management, and then Ashmore bought us. And then before that, I worked for a company called Charles River in Boston, but my last position was in London. So I moved from London to Arlington, Virginia. So I live in Arlington, and I cover, again, global markets for Truist Financial Corporation. And we see the same thing that Marianne has been talking about in global scale. And the ports are congested in China, congested in Europe, and also here in LA. LA has the biggest problems in the US. But when you look at the ports in Europe, the main ones like Antwerp, it's also congested. And China, because of the zero COVID policy that they kind of enacted last year, and also they kind of continued this year. So even if there's one case, they kind of lock down the entire city. They do a lot of testing and then mandatory social distancing and stuff like that. That's also that's causing tremendous kind of ripple effect in the manufacturing lines. And and Marianne is seeing those. The stuff that she's expecting to receive from China. It's not produced on time, then it doesn't go onto a ship on time, and then it never gets delivered in LA. And it gets translated into prices, everywhere. And we look at the inventory levels globally on the manufacturing centers around the world, and those are the countries like Germany, Korea, Japan, and also China. We have an insanely low inventory levels everywhere. So what happened is the factories or the companies, they start selling whatever they have in their inventories, and now they're done. There's nothing to sell. So they have to bring new stuff in and then package it and then send it over. Then the question is why this has happened. Maybe, I should talk about a little about that to give you a good background. I mean, when the pandemic hit, and when you look at the US economy, just to give you an example, 70% of US GDP is consumption. And out of that, we have two components, services component and then the goods component. And then the services component, these are the stuff like maybe spend money on restaurants or haircuts or, ball games or leisure activities, travel and stuff like that. That, of course, with the pandemic stopped completely last year, right? And then the next item is the goods, all the stuff that we purchase for ourselves and for our homes and for our cars. A lot of people said, okay, I cannot spend any money on to leisure activities or anything outside. So that means I have to, renovate my kitchen, renovate my bathroom. Every person that I know is renovating their kitchens, right? And they're waiting for their refrigerators and their tiles and stuff like that. So there was a massive shift in consumption from services to goods. So that was a big bang. And then, Aaron, you mentioned it really nicely in all the fiscal and monetary stimuluses. And everybody talks about monetary stimulus a lot, but when you look at the fiscal stimulus last year, it was $5.2 trillion. So U.S. economy is $22 trillion. So if you push $5 trillion immediately into an economy, that's 25% of the GDP. This is what happens. People cannot spend on services. What do? They spend on the goods. Bam, it creates tremendous amount of ripple effects in the manufacturing lines and the shortages and inventory levels and stuff like that. And when you look at the cash balances in the banks, and I work for a bank, but the data is available everywhere. So we have extra $2 trillion saved in banking accounts, sitting in checking accounts or saving accounts that are earning nothing. So this is extra $2 trillion. It's like 10% of the US GDP is sitting and doing nothing. And the banks are trying to give that money via loans, and we look at those numbers as well. The loan demand is pretty good, for the mortgages or for the auto loans. Even the corporates are asking good amount of money from the banks, but there's still excess money in the system. And Aaron, you follow the Federal Reserve. I'm sure you reviewed the reverse repo data. It's a little bit technical term, but this is basically the banks have extra cash. They don't know what to do about it. They give it back to the Federal Reserve. That's $1.6 trillion. That's insane. We've never had a number like that. And on top of this, I live in Arlington, very close to Washington, D.C., and they're debating about, another trillion, maybe 2 trillion, maybe 3 trillion. Who knows, the infrastructure bill. So there's more money to be deployed into the system. I mean, I'm having a hard time to, have a screen porch built in right next to my house. I don't know how are we going to build new airports and highways and stuff like that anymore. So there are not many people, not many materials left. Anyway, so that is causing inflation to spike up. And the inflation that you really nicely explained, the 5.3%, the inflation that you see is like a complete package. Of course, if you are renovating your kitchen and your bathroom, your inflation is like maybe 25%, maybe even more. Because your spending basket is significantly different than the average person's basket, right? That's not going to change. And when I look at the the numbers that we have ahead of us for the 2021, we have September data needs to come out, October, November, and December, 4 months. And the last year's 4 months, surprisingly, they were low inflation, like 20 basis points or 10 basis points kind of thing. And I'm sure we will have much higher than those benign numbers over the next 4 months. So we will see 6% probably inflation in the US. And when was the last time we saw something like that? It was 1990, right? And it will be an eye-opener. And again, I'm looking from an investor's point of view, because I create portfolios, I design asset allocation models based on what the inflation numbers look like. So if the inflation is 6%, and if the interest rates are 1.5%, then what do? Right? So you lose money if you don't invest into risky assets. Because you go back to 1990, where we had 6% inflation in the US. At that time, we had a 10-year US Treasury yield at 8%, so 2% higher than the inflation. So right now, the 10-year US Treasury is 1.5%, right? And then inflation is 5.3, and it will reach probably 6%. So you will be losing money, 4.5% at least this year, if you had the bonds in your portfolio. So we try to create portfolios invested into the global markets, also into the US markets. We prefer the US markets right now over the global markets because the US economy is doing fantastic, versus the European markets or versus Japan, like another developed economy, or the emerging market economies, because they're struggling with the higher energy prices, and they didn't have the fiscal stimulus that we had, and they didn't have the pristine currency that we have here. The US currency is, again, the world's most important currency, and we can control it. So we had that luxury here over the other developed economies and the emerging market economies.
So it sounds like you're telling, oh, I'm sorry. Go ahead, finish that, Eylem.
No, I'm finished. So I hope that answers your first question.
Okay, yeah. So it sounds like what you're telling your clients is it's a chase for yield to try to overcome the effects of inflation. Is that what I'm hearing? Yeah, no, that is correct. You have to take risks. If you're a income investor, you have to go to higher yielding bonds, starting with the US high yields, or eventually you look at overseas markets as well, which we don't recommend at all. If there's anyone listening, we don't recommend emerging market bonds in the dollarized space, or corporate bonds that are in dollar terms, or we don't recommend the local currency emerging market bonds as well, because these countries, they have significant problems with inflation coming in.
And they didn't have the best response to the coronavirus crisis anyways. Our response, the US's response, was much better than many countries, including many in the developed space as well. And that's the reason why we recommend US equities versus the developed market equities or the emerging market equities. Not only that, we recommend US high yield. If you have to have high yield, trying to get it in US than going to overseas markets. First of all, the developed markets, they don't have any yield. I mean, we're talking about 10-year treasury here, 1.5%. I mean, German 10-year is negative. So you don't want to hold any European sovereign bond because of the really suppressed yields versus the, what we have in the US.
So I'm going to go to a couple of questions that were submitted, and you touched on this a little bit, but one of the questions is what impact, if any, you think the current shipping crisis and supply chain constraints will have on inflation moving into next year and beyond?
I mean, my view is, yes, this inflation is transitory eventually, but then the timing is a big debate. And I would say next year we will have still high inflation, and the year after that high inflation as well. And it's kind of written in the, again, going back to the cash balances in the banks or the saving rates that we had. US consumer, when you look at historically, they don't save that much. So our savings rate on average for the last 20 years is less than 7%. But what happened with the pandemic is we moved up to like almost 15% savings rate. Now we're still above double-digit saving rates because we're not fully back on spending mode, and the cash balances are piling up, and eventually that will go into the market and buy something. It could be goods, or eventually, hopefully, it will be services as well. And I don't think what we're going to see is going to be solved immediately over the next 3 months or 6 months. This is going to take maybe 2 years. So I'm talking about 2 years in a row on top of 2021. Let's assume we will have 6% this year, and then the next year it will be even higher than the 2% target that the Federal Reserve has. Let's say 4.5%, and then another above 2% a year in 2023 as well. It looks like it's in the game, and eventually the other countries in the emerging market space and the developed market space will open up too. So this is. Right now, US consuming all available services because US dollar is the most important currency, and everybody would like to sell it to US. But eventually, there will be demand coming from Germany, from Japan, from emerging market countries. I mean, thank God, China is slowing right now. I mean, their growth rates are. A lot of people assume that this year they will grow at 9%. Now it came down to 8%. Next Tuesday or Monday, IMF will come out with numbers. Probably it will be like 7.8%. I hope they will grow 7% or 6.5% so that we can grow. Because we need the materials that they have been consuming over the last many years.
Let me go to another question from one of the attendees, and this is for you again, Eylem, and then I'll jump back to Marianne and get some feedback from her. With inflation up and interest rates expected to increase in the coming years, are you seeing a shift to alternatives to traditional finance for private or institutional investors, real estate, private credit, et cetera?
Yeah, that is happening, but we cover mostly listed markets, which is the listed equities and also listed real estate. We really like the listed real estate in the US. So we recommend, for portfolios, but because eventually the excess cash will go into real estate investments as well. And as long as the interest rates are staying as low as it is, the financing of those projects will be easier, and there will be a good amount of demand for real estate projects. But at the same time, when you look at equities versus fixed income, we like equities over fixed income because there's not much yield. 1.5% is not good enough. And within the equities, now the mid caps and the small caps, they look a little bit more interesting versus the mega cap companies like the Facebooks and the Microsofts and Amazons and stuff like that. But when you look at the top of the S&P 500 type of index, of course, there are companies, including Microsoft and Amazon. The ones that are dealing with inventory-related issues are not doing that well. For example, Amazon would be the best example. Amazon versus Facebook versus Microsoft or Google. any company that doesn't have to deal with inventory is doing better than the ones that are dealing with inventories. And Amazon, even though it's a software company, they do lots of services. You can see that even they're having hard time to find products to sell, right? And that's the reason I believe it was yesterday or the day before, they came out saying like, hey, Christmas shopping, you should do it earlier because we don't know if we can get it on time before Christmas. So that's happening, of course, in the smaller market caps and the mid caps. But eventually, those problems will be solved, and they should do in theory better than the larger caps. So an equal weighted S&P 500 should do better than a typical S&P 500, meaning a market cap weighted, which we would recommend that.
Great, thanks. So you mentioned inventories. Marianne, do you have any inventory on the shelves right now?
Some, no, actually, we do, but we're also, because of a lot of allocations and the supply chain trying not to have people do hoarding, but there's so much hoarding out there. It's hard to get materials, right? And another thing that we've seen mid-sized companies and even large organizations doing is that if you hadn't been having a supply customer relationship, they're saying under the guise of pandemic, you've seen a lot of organizations asking for funds up front. They want 50% down, 100% down. When they do have material to sell, that's a way that they can get the cash flow going. So you're seeing organizations that need material there, but they don't have the cash up front to pay for it. And so we've seen that as being in the sort of the distributor in the middle. You're the one managing all of that, and that cash flow piece has added another negative factor on board. But I do see some commodity lines easing up. I'll give you an example. Everyone and their brother was looking for nitrile gloves and masks, and we do PPE, and no one could get that, right? And so organizations, even Malaysia was shut down for quite a while, the biggest glove producer in the world, and so now you're seeing an influx of that type of material coming through, but you also see the demand going down. So the different commodities, metal, steel is terrible. Some of our automotive customers, they have someone waiting for a pickup truck is going to be going on 8 months, 9 months to get a new vehicle. So it's the basics, we're not going to see, I don't think we're going to see lines for toilet paper again, but it's tough out there.
I tried to buy paper towels the other day and I couldn't get them at Costco.
Well, you're going to just pay a higher rate and go somewhere else,
Yeah. So, what are the things that you see, say, like 2 years out? What are the challenges that you think are still going to be there in 2 years for you as a business? How are you likely to respond to those changes? What's going to be permanent and what's just we're muddling through and trying to get through?
Mm-hmm. I mean, I definitely agree with Eylem about the 2 years. I mean, some of our supply chain, some of our customers, they're going demand maybe 2 to 4 years out. And if their ultimate customer is the US government, so we have demand schedules that go out 4 years. And I see the third year, how are we going to meet that demand? Because we're going to be so backlogged. Even if things start to ease in 2 years, you're still going to have to produce to meet those schedules. And I see the pain for us 5 years out. I really do. I mean, it may ease up in the third year, but we do have to change our strategies completely. And just additional sources. We're looking at partnerships. Several of our suppliers have gone away for good. They didn't make it through 2020. So it's almost like we're in a phase of startup in so many of our categories.
Yeah, so my question was, which I think you partially answered, is it a labor issue that you foresee or an inputs issue? And it sounds like it's more on the input side.
It's more on the inputs, right? I see the labor issue resolving in less than 2 years for us. I mean, I see the labor issue, but I feel like the supply chain, the effects are going to be long term.
Thank you. Eylem, I want to go back to you because you have a really interesting perspective on the sort of the international dimensions of this. How do you see other countries sort of muddling through to a normal state compared to, say, the US? Are there countries that are going to be better off sooner than us, or vice versa? What do you think?
In terms of economic activity, or
yeah, economic activity, sort of labor market normalization, those kind of things.
Yeah, I mean, Europe has structural problems, to begin with. Before getting into coronavirus, they had population coming down, their working age population was coming down. They had significant issues. And actually, if you're talking about working age population coming down, Japan had the biggest issue. Japan's population is coming down, 500,000 a year. So in 10 years, they will lose 5 million, population out of the country. And there is no an easy solution to that unless you open your gates and bring immigration into the country, and boom, your labor, gets better. And they're not planning to do that. The countries that have labor availability, I would say the number one would be the country that I used to follow a lot, South Africa. Their unemployment rate is at 30%, but the government is having a lot of problems, to deal with the country's inequality and bringing jobs into the country. The countries that have a lot of commodities, so they will have a good benefit coming out of this. Countries like Peru or Chile. So both of them are producing copper for the world's use, but both of them are dealing with political issues. And then you have the massive country Russia that produces lots of commodities for everybody and energy, but they have a declining population problem as well, and they have almost full employment. And the only good thing for them is they're selling wherever they're selling at the higher prices, right? And then the countries that are in the extreme manufacturing, storyline, like I mentioned, Korea, Germany, and Japan. So they're dealing with these inventory-related issues. So no one is better than US, to be honest with you. The great story with the US is, thank God, we signed the USMCA deal with the previous administration, so that replaced the NAFTA. Right now we have a free trade complete agreement with the Canada and the Mexico. That's great. So we can, buy almost anything from Canada and then produce it in Mexico and consume it here. Not only that, US, has its own energy too. So we don't have to import energy from somewhere else. So we have enough natural gas, we have enough oil right now. That's fantastic. Not every country has that, luxury. And that's kind of one of the reasons why we kind of like the US economy versus all the other economies. Because, when you look at country by country, every country has its own problems. Of course, and we do have our, problems as well, but, it looks like, ours is a little bit, easier and a little bit better than the other ones. And then when you look at the main economies, outside of the US, like China, now, they're trying to, work on the inequality angle, so that reduces their growth rates. And then we have India, they will have 300 million people to be added to their workforce. They have to find jobs for them. And it looks like, India would be the country where we will have lots of labor. And also it's the largest democracy in the world. And it's partnered with many westernized countries. So India could be a country that could take the manufacturing lines, maybe from China and maybe from Southeast Asia, like, from countries like Vietnam, Malaysia, Thailand, and Indonesia. There's not much labor left, especially like, Thailand. When you look at the Thailand unemployment rate is like less than 2%. So it's like everybody's employed. You cannot produce more. So you have to find another country that will have a tremendous working age population growth. I would say that's India.
Thank you. I want to go back to Marianne. Again, as a small business owner, I'm curious, and I think a lot of our guests are curious about, again, some of the challenges that you face in particular. And I'm kind of curious too. And by the way, I would invite people in the audience, if you have questions, please go ahead and put them in the Q&A window, and I'll try to shuffle those around to our guests at some point. But Marianne, I'm curious, is there a policy angle to this which could be either inhibiting or potentially helping you and other fellow small business owners? And what I mean by policy is, policies at the state, local level, or even the federal level that are getting in the way of you being able to overcome these challenges with the labor shortages, with input costs rising, supply chain issues. Are there things that you can see that might make a difference even on the margin?
I see one that hasn't come through yet. When you mentioned the state level, everyone's calling it the potential. It's been on the Hill for a while. Boston, calling it the millionaire's tax, and for us, small businesses, it's going to hurt tremendously if that comes through, because you don't realize that many, many small businesses are S corps. So all of that income that will then be additionally taxed at a higher rate, everyone says, oh, it's 4%, it's 3%, but it ends up being, 45% tax rate, additional. That's going to, hit the company, because I'd say for the most part, you see, healthy small businesses that are S corps putting the money back into the into the company, putting it back into the employees. So that is a scary thing on the horizon as well. That if that were to come through next year, if it goes in front for a vote, and I think you address it comparing it to people that want to have social change and want everyone to pay their taxes. And I have to say, I want Amazon to pay their tax rate. I'm sitting here paying my taxes and in a threat of having my taxes increased in the company, and the big corporations are not paying their taxes. For us, that, I look at that and I'm supporting all of these large organizations that are, beating me up for 4%, but yet not putting the taxes back into the US. So that's what I see that happening, constantly, is that I feel that when 2 years comes, all of our customers are going to turn around and start asking us to, oh, it's about time to lower your pricing, and we're going to go out to bid. I feel that this is going to be a constant threat coming from every angle.
And I'm just curious to follow up, how are your competitors in that space? How they've been situating themselves? What's the sense that you get from your competitors about how the path forward is?
I see them locking down and looking at their best customers and looking at the service levels and supporting, almost telling, an opportunity to take those customers where they're not making large margins, but are taking up a lot of work, which is usually the 80-20 rule, and having a chance to, cut their arm off to save. And I see the competitors really looking inward, like strategically, which is going to help them, only strengthen them. And in a way, it's giving us a little bit of opportunity to maybe pick up those customers that they're getting rid of.
That's an interesting perspective. I didn't think about that.
Yeah.
Eylem, let me jump back to you. Marianne mentioned taxes at a more local level. I'm assuming that you have some sort of perspectives on this from a global level, because there has been a debate recently about the U.S. tax structure and how that compares to other countries, and how that impacts growth in the U.S. relative to other countries. Can you provide some perspective, your own perspective on that, and where you see that debate going?
Maybe from a very different angle, and we're talking about inflation, and I always see inflation as another form of tax. So let's say you're a wealthy person, you have 100 million saved in a bank account, and you didn't want to take risk, and you bought the safest asset on the planet, let's say U.S. Treasury, which is debatable right now with the debt ceiling discussions. Anyway, so 1.5% return, and then the inflation is 6%, you lost 1.5%. So that's a tax. So let's assume I'm a politician in US and I say I would like to introduce wealth tax. I would like to put a 1% tax on your wealth. Would you elect me? Probably not, right? But if I create inflation, so behind the scene, if I grab 4.5% from your wealth, you would not even notice it, right? So it looks like that's going to happen not only in the US, but all other countries as well, especially in the European context. So when you look at the European yield curves, again, many countries are at the negative level, meaning same story in Germany. You'll be paying your German government 0.5% when the inflation is, let's say, 2%. So that means your wealth is going down 2.5% every year. Your purchasing power parity, or the purchasing power of your wealth, goes down significantly. So you have to find a way to protect that. In terms of competitiveness, one country versus another, yes, we're trying to do this global tax rate for every country, and I'm sure there will be countries that are finding ways to get around it. As long as we're competitive in terms of human capital, meaning bringing new ideas to the table, and as long as we have the capital to deploy those ideas, which we do, and if that capital is relatively cheap versus all other places as well, which it is, then we can compete. I mean, it doesn't matter that much if the tax rate is 23% or 27% or 25% at the end of the day. But of course, looking back, the 2017 tax cut was too much. I mean, we didn't need it, first of all, and not only that, for competitiveness purposes, and we didn't have the fiscal balance sheet to do it, but we did it anyways. So cutting taxes is super easy, but introducing a brand new one is insanely difficult, right? And that I believe that's what's going to happen. We will see a lot of headlines that, hey, the taxes will go up higher and higher, but at the end, it doesn't happen. Then that means inflation needs to take that place. And maybe that's the reason why the inflation should be, or could be, higher than the 2% that we have been talking about over the last many, many years. And the interest rates will stay well below whatever the inflation rate is. So that means there will be a tax on the wealth that you've created that you didn't want to take risk. I hope that answers your question.
Thank you. Thank you. Let me go back to some of the questions that some of our audience members posed. One question was going back a little bit. I think we were talking about supply chains and inflation. The question from Stephen Adino, following that point, how long would the $3.5 trillion reconciliation effort extend the supply chain crisis? And so I'll sort of put my perspective on this, in that it's not going to necessarily help or hurt. The supply chain issues are there primarily as a result of the disruptions from COVID, the global links in the supply chains. And so it's not just a US phenomenon. Now, certainly people would complain more because, with the spending that eventually finds itself in the pockets of people who want to spend it, and maybe still not have the goods and services that they want to spend it on. But in and of itself, it wouldn't necessarily, in the near term, in my estimation, affect the supply chain crisis for better or worse. But the idea of this infrastructure package in the longer term is to, again, enhance the infrastructure, however you define it, to make the economy more productive. So in that sense, in the much longer term, it should help eliminate some of these potential problems that we could have, that we've seen today. Let me go back to Eylem, and there's another question from Sean. He says, is there still room for growth left in the US economy? What would cause things to slow down?
Yes, there is. I mean, if you look at the Federal Reserve's projections for the long-term growth rate of the US, it's 1.8%. It used to be 1.9. They reduced it last year to 1.8. This is a long-term projected growth rate for the US for, let's say, 10, 20 years. And we believe the US can grow much faster than that. On average, over the last 20 years, I think our growth rate was like 2.3%. This year we will reach probably close to 7%. And it looks like, with the pent-up demand and the cash balances and the activities we're planning to do on the infrastructure spending, the US can easily grow greater than 2% over the next 4 or 5 years. So if there is no unforeseen events, I mean, the coronavirus was an unforeseen event. Actually, before that, we were talking about the Australian kind of story. Australia had an uninterrupted 28 years of growth rates. Can the US do the same thing? And we were saying, yes, it is possible, unless there is an unforeseen event shows up. And coronavirus was that unforeseen event. We had a massive recession pretty quick. And then we recovered back because of the fiscal stimulus, massive fiscal stimulus, and then the monetary stimulus. And now we have, hopefully we will have a little bit higher productivity rates as well. Now we figured it out how to work from homes, and have these Zoom type of meetings and a bunch of other things. And we have the gig economy. The gig economy got better and better with the coronavirus. Hopefully that should increase the productivity rates of the growth rates of the US. Because at the end of the day, productivity is the only thing that matters, right, in the long run. It doesn't matter, if there is more people coming in, you increase your GDP by immigration, or you find oil, you start extracting that, and then produce that increases your GDP. But for a sustainable growth rate, we need to have productivity in the economy. And the question is like, are we more productive now? And I believe we are more productive now because we have more tools at our disposal, and we can continue with these learnings, and hopefully, labor will be retrained into the areas that we would like to have, and that will improve our productivity rates even higher.
Thank you. I know we are pretty close to time. I want to give Marianne the last word, or the last question here, and we can make it very brief, Marianne. If we didn't face these labor issues and you didn't have the supply constraints that you had, could you double or triple your business right now?
Yes, I probably could. I'd say that we actually, in 2018, we had down that we would be at like 60% increase in business by year end of 21. I do just want to make a quick comment on what Eylem said about the labor. And I've also seen many of my customers become more efficient and have no intention of bringing back some of these jobs. They're not going to come back. They've become lean. They've figured out a way, either whether it's by technology or, the Six Sigma value stream the heck out of their organization. But I do see that too. You've got some, some companies have become much more efficient in the year and a half.
Thank you.
Erin, maybe before we close, can I say one last kind of high note? We're talking about inflation. We're worried about supply chain, problems. I've read an article coming from Mexico. The tequila production this year will be at the highest. So there will be no supply problems on tequila this year. So I hope that, the prices of that, will stay the same. So we can, finish the presentation with that high note.
Yes, we need our tequila to get us through. Well, I want to thank our guests, Marianne and Eylem, and I also want to thank our attendees here. Fascinating conversation. So thank you, Emily, for putting this together and connecting us all.
Oh, you're welcome. Thank you all for your time. Thank you, those of you who dialed in. If you want to connect with any of our panelists, we will include ways to connect with them in our follow-up email. So again, be on the lookout for that. And we hope you join us again for a virtual event soon. Thanks, everyone.
Thank you.
Bye, everyone.